Bond valuation. Bond valuation. Your financial management examination is basically about investments. Again, you'll be looking at financing decision and risk management. Bond valuation can fall under your investment decision. Remember, under your investment appraisal, you have different methods of appraising and investments. So you have the capital budgeting, which deals with long-term investments in capital assets. It's not all of your investments that will be in capital assets. You may also have investment in financial assets. For instance, like bonds. Bonds are basically investments in financial assets to an investor, and it's like a financial liability to the company issuing out the bond. So your bond valuation also could be a financing decision from the side of the company and also from the side of the investor. It's an investment. So it depends on which area the company fall. Is it the company that is buying the bond, or is it the company that is issuing the bond? Now let's look at bond valuation. What is a bond? What's a bond? A bond is a written agreement. It's a written agreement between the holder and the issuer of the bond. The issuer promises to pay back the principal at a specific date. So look at this keyword there. There is an amount borrowed, which is the principal amount, and it's going to be repaid back on a specific date. The issuer of the bond is obliged to pay interest on the principal amount at a regular interval. This should be the issuer of the bond at a regular interval. So in essence, the lender is the investor. The issuer of the bond is borrowing money from the investor to repay back on a specified future date. So if a company needs to raise money, the company can raise money through issuing of bonds to the public. Now, the bond is a written agreement. So let's say it's a paper, a written agreement to pay 2 million naira at a specific date. So this 2 million naira that the investor used to purchase this bond is an investment to the investor, the lender, or the investor. The investor expects to receive interest at a regular interval, which may be quarterly or semi-annually or annually. So if the investor receives 10% interest on 2 million annually, and the bond is to be redeemed in 3 years' time, it means that the investor will receive 10% times 2 million naira year 1, year 2, and year 3. At the end of year 3, the company or the borrower returns back the principal amount that the investor used in purchasing the bond. Now, the principal amount could be refunded back at par at a discount or at a premium. So at par means that if the nominal value of the bond, amount written on the bond is 2 million naira, the borrower is going to return 2 million naira at the end of the tenure of the bond. At a discount, maybe a discount of 10%, if it's at a discount of 10%, it means that the borrower is going to return back at the end of year 3, 2 million naira times 90% back to the lender. But if it is at a premium at the end of the tenure, let's say premium of 5%, for instance, the bondholder will receive 2 million naira times 105%. If it is at a premium, 5%. We have two basic types of bonds. Basically, we have two types of bonds. There are different types of bonds, but for this lecture purpose, we'll be looking at just two types of bond. And the first is the straight bond, and the second is the convertible bond. The straight bond and the convertible bond. What is a straight bond? When we say straight bond, we are saying that there is no option for conversion. A straight bond is a bond that pays interest regularly at regular interval, and at maturity pays back the principal or the original amount that was invested. So there's no option of conversion here. The investors will eventually receive cash at the end of the bond tenure. A convertible bond is different from the straight bond in the sense that at the end of the tenure or at a specific future date, the investor have the option to either receive cash or convert the bonds to shares. So a convertible bond is a bond that can be converted into ordinary shares within a specified period of time at the option of the holder. At the option of the holder. So it's the holder of the bond, the investor, that has this option to either convert to ordinary shares or to receive cash at the end of the loan tenure. So the bond, in essence, is a loan given by the investor to the issuer. What are the advantages of the convertible bonds to the investor? So let's look at the advantages of the convertible bond to the investor. The investor is also the lender. Number one, the value of the convertible bond will rise if the market value of equity rises. So the investor has two options, either to receive equity or to receive cash. So if the value of equity rises, it does mean that the value of the bond as a convertible will also rise. The second advantage to the holder is that the value of the convertible bond will not fall below the value of a straight bond. So what do we mean here? We'll say the value of the convertible bond will not fall below the value of a straight bond. If the value of the convertible bond is, say, 120, if converted to share, and 100 if investor decides to receive cash. This is cash, and this is shares. A rational investor will prefer to convert the bonds to share and receive 120 naira worth of shares, even if the investor doesn't want to hold the shares. The investor may decide to sell the share at 120 naira, and this will be higher than if the investor has received cash of 100 naira. Finally, a convertible bond ranks before ordinary share in the event of winding up. So those are the advantages of the convertible bond to the investor. Now, the advantages of the convertible bond to the company. Number one, if conversion takes place, it means that the convertible bond will be self-liquidating. A company borrows 2 million naira in bond, and this will be paid back redeemable in 5 years' time. Means that at the end of the 5th year, the company will need to pay back 2 million naira, and the company will need to source for that fund if the company does not have enough cash to pay back the 2 million naira. But if conversion occurs, it does mean that the company will only give the investors shares worth 2 million naira, and the company will not have to look for funds to pay back these 2 million naira because investors will receive share. So if conversion takes place, the convertible bond is said to be self-liquidating. The interest rate is lower than the interest rate of a straight bond. That's the second advantage. Convertible bonds are often less restrictive if the interest and they should be earned, and the interest is tax deductible. Convertible bonds are often less restrictive, meaning that if you borrow money from a bank, the bank may decide to give some conditions which are called covenants, that, for instance, sharing will not be more than 90% equity, 10% debt, or 70% equity, 30% debt. This is called the sharing covenant. Or the lenders may also say, maybe a bank, for instance, that there will be a revenue covenant, that the company must be able to every month have a revenue maybe not less than 2 million naira, and some other sort of covenants. For the convertible bond, they are less restrictive. They have less of the covenants. And also, interest on convertible bond is tax deductible.